It is Tuesday, December 15th, a couple weeks left in the year. My name's Guy Adami. I'm joined by my dear friend, Dan Nathan at Risk Reversal. We're here for the macro setup brought to you by our presenting sponsor, Nadex, the premier exchange for trading binary options, call spreads, and what else, Dan?
Knockouts, big guy.
Knockouts. And you know what? You're a knockout, Dan, and you've been on fire lately. And let's just talk about the market. We'll round for you. Dow 30,000, NASDAQ 12,500, S&P 500, basically 3,700. I never thought we'd be here on December 15th, but here we are. All the headwinds, I guess a lot of tailwinds as well. We'll speak about both. But what are you looking at, Dan? Let's get right into it.
Yeah, getting into it. I mean, listen, like you said, Guy, the S&P 500 is up about 14% on the year, very near its all-time highs, up about 65% from those March lows. And you just said something that I never thought we'd be here. I think a lot of people didn't think that we would be here from an investment standpoint because 2020 was a year, for the first time in a very long time, where people weren't most focused maybe on their money. There were other things to kind of keep an eye on. There was obviously huge health insecurity. There was job insecurity. Obviously, now there's wage insecurity. So, thinking about too much about the stock market seemed maybe at times a little insensitive here. But here we are on, 2 weeks to go. We have the vaccines rolling out. The second vaccine for the coronavirus is likely to be approved this week from Moderna. We know the Pfizer one is shipping. And there seems to be a lot of optimism in the investor class for what that means for the economy reopening in 2021 fully, and what it means for unlocking or unleashing the earnings power of the components of the S&P 500. Listen, like you said, you never thought we'd be here. I think there's going to be major scar tissue on this economy going forward. And I think as far as the stock market is perceiving the vaccines and what it means for the earnings power, I think it's pulled forward a lot of optimism about that. So I'm a little less optimistic about Q1 2021 performance in the stock market. I think it's going to be a bit of a rocky road back to where we were pre-pandemic.
Stands to reason. And, I think a lot of people still believe we're just going to continue to go up in a straight line in terms of the NASDAQ, the S&P 500, obviously the Dow Jones Industrial Average. Maybe you'll get this rotation from growth to value that people have been waiting for, or some people have been longing for. But I don't think it's going to be that straight line. And again, valuations, in my opinion, do matter. And I think a lot of people believe that earnings in 2021 are completely dismissed, throw them out. It's all about 2022. But even if you want to make that argument, which I'm not looking to make, you're still talking about 2022 earnings that are far surpassing the expectations for 2019. It's absolute madness when you don't really have that kind of earnings growth. And oh, by the way, you're still talking about an environment that's at best hard-pressed to get anywhere near 2019, yet the market seems to suggest otherwise, Dan.
Well, listen, in 2019, you know how much the S&P 500 earnings grew? They didn't. And the stock
not a lot. Yep.
And the stock market went up 30%. So here in 2020, we obviously have this unforeseen catastrophe that's caused earnings to decline at least 20-some% when it's all said and done here. And this S&P 500 is up 14%. Let's go to the 1-year chart. There's a lot of events here, and we want to cover these things. So the Fed is starting their last 2-day meeting of the year. So we're going to get some commentary tomorrow out of the Fed. We know that the Electoral College yesterday just certified the election for President-elect Joe Biden. So on the political front, the real next kind of target is going to be that Jan 5th runoff in Georgia for those 2 seats that will determine, who controls the Senate, which really means who controls the agenda going forward, because we know that the Democrats have a majority in the House. They obviously have the White House. If they were to take these 2 seats in Georgia on January 5th, then the Vice President-elect Harris is the tiebreaker in the Senate. And then all of a sudden, the Biden administration can kind of flex a little bit. And what does that mean? That means maybe higher taxes, tighter regulation, that sort of thing. The stock market, not sure it's pricing that. What do you think if we were to see the Dems take those 2 seats? The stock market from the November lows is up, 14% in a straight line or so. What do you think happens to the S&P 500? Let's look at that 1-year chart, because there's a couple really good lines there.
There's no way, in my opinion, that the market is pricing that in. There's absolutely no way whatsoever, because I do think in terms of what it means for the broader market, I think it really would be negative. And I just think the market's completely looking past that. And one thing you didn't mention is the fact that current President Trump, and again, we're not talking about politics per se here. We're just trying to read the tea leaves. I mean, he has still done anything but concede. And quite frankly, I don't think there's any way he's going to concede. And there are probably 100 million people or so in this country that still think he probably won this election. And I just don't understand how that sort of reconciles and how it ends in a normal fashion. So I think this thing will continue to escalate into January and probably early next year. And, we're not going to get into the VIX per se today, but a VIX at 21 and a half, 22 is no way pricing that in. And an S&P 500 that seemingly goes up every single day is not pricing that in. So when you overlay the Georgia runoff, I believe on January 5th, the fact that current President Trump probably is not going to concede and that a third of the population still thinks he's won the election, I think that's a bit of a witch's brew here in terms of the market, that to your earlier point, there's no way we're pricing in that kind of tail risk, Dan.
Yeah, so looking at this 1-year chart, we see that if you draw a line from the February highs, you connect it to that September 2nd high and some of the November 9th, the day that we had the Pfizer news about its vaccine. And then last week, you see some technical resistance there. And you see the S&P 500 kind of struggling. It's up today about 55 bips or so, but still below that resistance line. Then you kind of go and you look at that nice round number of 3,200 to the downside. That's where the S&P 500 found some support in September. It found some support in early November. We also see the 200-day moving average creeping up for there. I think a pullback back towards that level would be a very, very healthy thing. Get back to a point where sentiment indicators, you see that city euphoria panic index is just maxing out at the euphoria levels. I think sentiment's a little too hot here. I think kind of scaring some people out of this market would be a good thing for 2021 returns. Just zooming in a little bit, here's the 6-month chart. You see that just below 3,600, that would be really near-term support in the S&P 500, down 2-3% or so, and then really breaking that uptrend that's been in place since early November, the ramp right after the election. That's the way I see the S&P 500. I think a pullback to 3,400 would be pretty healthy. But guys, let's go to the NASDAQ 100.
Well, hold on one second, Dan. I don't mean to interrupt you. I apologize. So first of all, we work with a crack staff at Open Exchange, and I'd like to go back to that earlier S&P 500 chart. Okay. And I'm not asking you to draw lines because you can't do it at this point. But what I'll tell you is, because my eyes work this way, Dan, there's actually a line you can draw from the March low to the November low, which to your point is right around 3,200. And by the way, guess what? The third point on the downside would come in right at that 3,400 level. So you have a bit of a pennant forming. We're at the upper end of this range. And Dan, that 3,400 level makes a lot of sense for a lot of different reasons. So if you're trading knockouts, binary options, and those type of things, 3,400 in the S&P 500 makes a tremendous amount of sense. And I'm sorry to interrupt you, but continue on your journey with the charts, Dan.
No, I was going to pass it over to you, the NASDAQ 100. To me, what I find most interesting about the NASDAQ 100 is that actually 6 stocks. You know what they are? It's Microsoft, Apple, Google, Amazon, Facebook, and Tesla. They make up 50% of the weight of this index of 100 stocks. They're close to $8 trillion in market cap. Just made a new high recently, despite the fact that Microsoft, Apple, Amazon have really been going sideways for the last couple of months. None of them have made new highs here. That's part of that rotation here. So, we drew this 1 year, we drew that uptrend from the March lows. We connected it to the early November lows. We see that new high here. What's your take on the NASDAQ 100? Do you think we'll see a re-rotation back into these mega cap tech names, out of the S&P 500 and continue the NASDAQ outperformance into the new year?
You think about where we are, we're probably 22% off that 200-day moving average that you have shown there. That's the yellow line, by the way, folks. And the 200-day probably comes in somewhere around 10,300 or 70 or thereabouts in the NASDAQ. And again, if you've watched this, which hopefully all you folks have, I never thought we'd retest those August highs of 12,400. But here we are. What does it say to me? Well, that uptrend is still in place. But guess what, folks? You could still see a significant pullback and still be in that uptrend. But a break of that line, and it looks like it comes in spot at 12,000 in terms of where support is. I think there's a very good chance that you're going to not only breach the late August, early September lows, but you're going to test that 200-day moving average, which, by the way, we really haven't been anywhere close to since April. So, I understand that the market's being powered by 5 or 6 different names. And I guess it's somewhat encouraging to your earlier point that the NASDAQ has been able to go higher despite the fact that Apple, Microsoft, Google, Amazon have sort of been sideways. But you've seen recent strength. And, there's some news out in Apple that a lot of people getting all geeked up about the fact that they're ramping up production 30% or so I saw. And obviously, you had the battle of the Titan tech analysts, Microsoft, in terms of Apple, with Morgan Stanley raising their price target and Goldman Sachs actually going negative on it on the same day. We'll see how that plays out. But I think you make a fair point. At a certain, there comes a point in time where the market can't just be driven by 5 or 6 different names. And I think we're precariously close to that, Dan.
Well, one of the reasons I'll just mention, let's zoom in on the NDX, though. We have a 6-month chart, and it shows that this is actually a pretty healthy consolidation, really, between 10,500 and 12,500 or so. So, like, the idea of chopping around in those levels that you just kind of identified, setting up for another move. Just remember, trees don't grow to the sky. We're going to talk about Tesla in a second, and that obviously is one of the examples to disprove that statement I just made. But really, to see growth stocks continue to power forward and do the outperformance, you need consolidations. You just can't go parabolic and expect that to continue to go. I see that going on in the NASDAQ 100 right here, despite the fact, listen, there's been headwinds. Google got slapped with an antitrust suit. Facebook is being, in a similar sort of fashion. Google's going to, or excuse me, we're just going to continue to see that a bit. Amazon is going to be on the radar of a lot of regulators. And so those are the sorts of things that you'd like to see the stock back and fill and consolidate, that sort of thing. But you see that uptrend there. There is risk down to that 11,000. Guys saying that you could maybe get down to that 200-day moving average over a period of time. Let's see. One of the things that I think is most interesting, we're going to talk about Tesla in a second, but we've seen all these new hot IPOs predominantly in tech. We've seen some massive valuations. You saw Airbnb nearing $100 billion market cap last week. It's come in since then. DoorDash, the delivery service. We've seen Palantir. We've seen Snowflake was above $100 billion. There's just a ton of deals coming. And that's not to mention the $77 billion in special purpose acquisition companies, the SPAC attack that is happening. All of those companies that raise money through IPOs are looking for private companies to take public. All of a sudden now you have a whole heck of a lot more of supply on the public markets trading at very, very high valuations. That combination, to use your expression of a witch's brew, is not great, especially when you have traditional, growth names that usually have been trading at a discount to a lot of the faster growing, smaller peers, really trading at stretch valuations in Apple at 30 times or Microsoft, that sort of thing.
One of the things that I've heard a lot over the last 6 months is addressable market. And the last time we both really heard that in earnest, was probably a decade or so ago, and if not 20 years ago, when people were talking about addressable markets. And that's, to me, that's a bit of a crutch. And I mention that because in terms of like an Airbnb, for example, that's sort of the buzzword. And to your earlier point, I think at its zenith, Airbnb was trading close to $100 billion valuation. And you're talking about a company that's probably going to do either side of $4 billion in revenue. You can do the math in terms of where that's trading in terms of market cap to revenue. I mean, it's just extraordinarily lofty levels. Now, a lot of analysts think we're going to see continued double-digit revenue growth. But again, just to do the math, you need 3, 4, 5 years of that to sort of grow into the current valuation. And maybe it will. I mean, maybe it's one of those companies, but just a lot of things going on now that are eerily reminiscent to what we saw a decade ago, if not 20 years ago, Dan.
Guy, in the business, they'd call that a really good segue, right?
Thank you.
And
Thank you. Appreciate that.
And it's amazing because you had no idea what's coming next here. But we're going to talk about Tesla. Tesla on November 16th was trading down about 20% from its prior all-time highs, just made, I think, a month or two earlier than that. They get the notice that they're going to be added to the S&P 500 index on the close of business December 18th. That's this Friday. Indexers have to buy the stock to kind of mask what's going to be in the index. That means they have to sell other stocks. So you've had traders who've been short. They quickly moved to cover. You had traders looking to run ahead of the indexers buying the stock. You had the Robinhood crowd who were buying calls. And, it was just like just a huge orgy of Tesla buying here. That stock has gone from 400 to, I think it's trading at 640 right now. It's gained more than 150 billion dollars in market cap. It's north of 600 billion dollars in market cap. That's not particularly natural. We're going to see how this thing trades next week. After, I mean, who knows where it's going between now and Friday's close. This could be an all-out mania, but it's just important. I'm going to throw this to you. We have a graphic here. I think it's from Wolf Research or wolfstreet.com showing that when Tesla's market cap last week was 578 billion, it was basically equal to the entire global market caps combined of all of its auto competitors. And what's really interesting about this is that right now, electric vehicles, which is the only thing Tesla sells, as far as cars are concerned, is like low single digits % of the global auto market, right? So we're talking about total addressable market, and we're seeing this disparity between market cap. It seems like a bit of a mania. Will you inform me of your thoughts here?
No, and let's pull up that. You did a nice little graphic where on the one side you have Tesla and its market cap, and then you compare it to 6 or 7 different automakers, and the market cap is spot on. So if the great Mike Covino can do the slide it all thing, and you'll see exactly what we're talking about. It is somewhat questionable that Tesla is trading at these levels, but the bulls will say, you know what, you're making a mistake. Tesla is not an auto company; it's anything but. So it deserves the valuations that we've seen. I'll say this in terms of the stock, and something I've said for a while on Fast Money. For me, all you needed to know was what happened back in May when at the pre-split price of 703, Elon Musk said, the stock is too expensive, or I'm paraphrasing that, something to that effect on Twitter. And the sell-off lasted for a day, and you've seen where we've been since. So every bit of negative news has been shrugged off. And oh, by the way, for you traders out there, the real move doesn't take place when the market goes from short to neutral. The real move takes place when the market goes from neutral to long, and that's what we're in the midst of right now. And maybe we'll culminate this Friday on the 18th when that ad is made. We'll see. But in the meantime, it's just all systems go for Tesla. And that's sort of the graphic that I wanted you folks to take a look at. You're talking about 1, 2, 3, 4, 5, 6, 7 automakers, and it's the same market cap effectively as Tesla is right now. That's one of those, what was that song, Dan? Things that make you go, when you were a kid? Well, that's something that makes me go,
Yeah, the kids were listening to that back in the 90s. Well, let's just look at these 2 charts here. I have, the company Tesla went public, in June of 2010. Here's a linear chart since then. You see what's happened here. In the mid 2019, the conversation was whether this company has enough cash to survive, right? And they were having some production problems with their mass market Model 3. Things have kind of changed there. This will be written about for years to come in books about manias that may replace the tulip mania from the what you were trading tulips when back in the 60s.
I was,
80s,
and I enjoyed that because not only was I trading the tulips, I was actually enjoying them in the vases that I would burn in my kiln.
Yeah. All right. So here's what another chart on a log basis. The 10-year in Tesla is pretty interesting. You see that they really went nowhere from mid 2013 until late 2019, and then you have all of that, or a lot of that performance coming then. So I want to compare this. I want to go back. Okay, I want to go back in time to really one of the first bubblicious stocks in my career, and that was Amazon.com in the late 90s, went public in 1997. But let's first look at this year. The stock's up 70%. It's got a $1.6 trillion market cap. We know that they're taking about a quarter of all new e-commerce sales right now. One of the things that I think is really interesting is you see the stock has gone sideways for the last few months. It had that huge ramp. They won the pandemic. They created a vaccinated supply chain directly to you. All of their competitors, for the most part, were closed. There was money put in consumers' pockets. They weren't allowed to go spend it in restaurants or travel or sports or concerts or this and that, whatever. They bought crap on Amazon. Okay, so they won the pandemic, but the stock's gone sideways. Investors are kind of thinking about what's next. Look at the 5-year chart.
Now, hold on 1 sec. I want to go back. I want to keep this chart up for a second.
The 1 year.
I want this chart now. I want you to take a good look at the March low, and I want you to take a look at where we peaked out at in late August. So just focus on that. If you're looking, folks, what you see is a very significant uptrend that has been broken. And you say it got this stock, to Dan's point, has traded sideways ever since that significant uptrend from March was broken in August. And now Dan's going to talk about something, but I just want you to sort of remember that as we look at Amazon, a series of lower highs since then, and you're in this pennant formation, then maybe we do break out to the upside. But I think we did break that uptrend in August, and I think we're headed for probably the September lows, if not lower. So with that, Dan, please continue.
Yeah, I mean, listen, I actually really like this formation. Again, it goes back to what I'm saying is that after a massive, massive rally off those lows, which is probably 100%, like sort of consolidation right now, especially as we're seeing rotation into cyclical, into value, all that new supply coming in high valuation names. This is totally healthy. I actually think this is one of the best looking charts in all of the NASDAQ. You know, if you see a series of higher lows, actually, Guy, you know what I mean? Now, you do see a series of lower highs, but to your point, it's making a triangle here. I'm willing to bet on Amazon that investors really won't care about that valuation for some time to come. But let's go to the 5-year, because this is really interesting. It just shows you that sometimes these consolidations go longer than you think, right? And so it took this sort of event of the pandemic to wake investors up to some of the stuff that we're doing. AWS is a huge part of this too. We know that cloud services and public cloud have been a huge beneficiary of all the work from home, school from home, that sort of thing. So that's been great for them. But let's go to this chart. Okay, this is where I'm bringing it back to Tesla. Okay, in the late 90s, okay, this was, you know, e-commerce was not a thing. They were selling books and DVDs and CDs online, and you know, people were afraid to put their credit card on the internet and all that sort of thing. And the stock had that massive ramp. It went basically from zero. You see what it did, you know, to but here's the thing: when the dot-com bubble crashed, it crashed. It was the poster child for it. It lost 95% of its value, right? And then it kind of the bubble reinflated, and in 2000 and 3, 4, stock topped out. Stock lost 55% of the value. In the global financial crisis, after a huge run, the stock lost 65% of its value. So, and there was no looking back from there. But my point, and I want you to talk about this, is that, you know, Tesla is just the thing right now, and the addressable market for EV, and they're going to change the electric grid, and they're going to do everything, but it doesn't go right from there to there. It's already gone up 1,700% in 2 years. So speak to that psychology a little bit as far as investors are concerned.
It's amazing that people seem to forget the moves that you just outlined, and it's there. The visual is there. So whether you realize it or not, these things have actually happened, and they've happened over the last 20 years. So to suggest that something like this couldn't happen in a name in terms of the euphoria around it and the story around it, like Tesla, I think it's just foolish. And again, Dan points out, you know, you saw moves like the moves you're seeing in Tesla. You saw in Amazon in 98, 99. You saw it again in the early 2000s. You obviously saw it again as we went from 06 to 2010. So to suggest it can't happen in a name like Tesla, I think is just foolish. So just buyer beware at these levels. And that's from somebody that sort of understood what's been going on in the stock since the spring. But if you do go back to that prior chart, I just want to show you one other thing, Dan, and I think you bring up a really good point. We made an all-time high late in 2018 in Amazon, and the chart sort of illustrates that. But look at how long we had sideways action in the name, from late 2018 till earlier this year. So again, this is a stock that maybe it just goes sideways for the next 6 to 9 months. We've seen it before at all-time highs. Maybe we're seeing it again now, Dan. I just wanted to show you what has happened as sort of an illustration of what could potentially happen as we move forward in 2021.
Yeah. So it's interesting. You and I get tagged all the time on the Twitter. What do you call it? Being added or something like that?
That's the, you know, they at me, as they say.
At you. Yes, they at you. And we're on a show called Fast Money, right? And so Fast Money, we're often talking about what happened today, might happen tomorrow, that sort of thing. You know, and it's kind of interesting to think of things through an investor lens versus a trader's lens. A lot of investors in a Tesla, a lot of investors in Amazon, all along this last 20 some plus years, you know, are telling you just don't see it. This is going to be huge. I get that. I see these secular shifts, but the stock market is a different mechanism, right? And it doesn't always work. And I know that the people think, or doesn't work correctly, right? And so my point is, you can be right about your view about Elon Musk and electric cars are going to be growing, just ridiculously and taking share, and the valuations assigned to them versus traditional autos are going to be different. I get that, but my point is right here: when you have a stock up 650% and gaining 55% in a month because it's going into an equity index, that doesn't make a lot of sense. You do not want to be the last person to buy this thing, even if you have a 10, 15-year time horizon. All right, let's go to the other big event here, Guy, this week, that Fed meeting. We talked about it here. I want to tie two things in together here, though. The markets also seem to be optimistic about the potential for fiscal stimulus. We know that Fed Chair Powell has been begging Congress, begging the Treasury, begging the White House to get their act together because monetary policy can only do so much. I suspect that is going to be a message that we hear from Powell tomorrow. What is your take on what comes out of this? What do you think about rates here? We'll talk about the dollar and rates right here because that's a really important trade. We just spent a lot of time talking about the stock market, but we know that rates and the dollar are really important here. So what's your take into and out of the Fed here?
It's interesting. I understand that the Fed is not a political entity. I totally get that. But I do think, given the fact that this election has now basically been called by the Electoral College for President-elect Biden, I think in a weird way that might give Jerome Powell air cover to talk about exactly what you just mentioned, the need for us to go from monetary policy to this fiscal policy and the baton handoff that he's tried to talk about for the last year or so. And by the way, every time he's brought that up in some context, you've seen a sell-off in the broader market. And my sense is he's going to bring it up again this week. So just be prepared for that. In terms of rates, you've obviously had this stealth rally in rates since bottoming out earlier this summer. And here we are as we speak today, 91, 92 basis points or so, and rates continue to creep higher. The bulls will say rates are creeping higher because not only is the U.S. economy getting better, but global economies are getting better. And that there may be some truth to that. I'm sort of taking the other side, that rates are creeping higher because central banks may be losing control. Maybe their firm hand on the steering wheel or on the tiller is not as firm as the market seems to think. I think there's this misconception that central banks control the entire curve. That's false. I mean, that's just patently false. They might control the front end, but that's about it. And as much as I'd like to think they control the entire curve, that's not true. And I think rates are going up, but I think rates are going up for the wrong reason. I think rates are going higher because there's inflation all around us and because the dollar moving lower is, by the way, very inflationary. So just keep an eye on rates. 1% has been a level of resistance for quite some time. I think we blow through it, Dan.
So let's look at this. We have a 1-year chart right here. You see that, like what you call the stealth kind of move higher in the 10-year Treasury. It got to 55 bips on the downside in early August, and we've seen a series of higher lows here. It's held that uptrend. 1% has been a level that the stock or that the yield has not been able to get through here. But you think getting through there, you could see a move back to kind of the breakdown level, which was right around 150 back in February. Let's go to a long-term chart because this is pretty fascinating. It kind of incorporates a lot of the themes that we've been talking about in the equity markets, especially over the last 20 years. Look at where the 10-year Treasury topped out in 2000 when the market topped out above 6%, in 2007 above 5% when the market topped out. In both instances, part of the recovery, whether you want to call it an economic plan to kind of put a stopgap in, or whether it was to fix capital markets, was to bring interest rates really low in both instances, right? And so what have we found here is that interest rates have never really been able to go meaningfully higher. We see that move, and you see that downtrend where we got to in 2018, back up towards 3% in the 10-year Treasury. What happened then, Guy, in the Q4 of 2018 when interest rates rose there?
The market was not particularly pleased. And if you remember, just to give you some context of what that was in October, if memory serves, of 2018. That's within a few months of Jerome Powell taking the basically becoming chairman of the Fed. And if you recall, he said two things. We're going to be on sort of this cruise control in terms of reducing the balance sheet, and they're going to sort of move towards normalized rates. And in the course of a month and a half, the S&P went down 19.9%, as Carter Worth would say, to the penny. And then they obviously reversed course in December, and we've seen what's happened since. But I'm glad Dan has brought up this 20-year chart because, listen, we're still in a bull market for Treasury, or effectively, I mean, it's somewhat counterintuitive, but a bear market for yields. In other words, yields have continued to go down, and we'll probably remain in that. But that's not to say that we can't get close to that 1.5% level that we saw earlier this year. So again, I think rates are going up for the wrong reasons. It doesn't really matter why. We'll see what the market has to say. But the last time we saw a meaningful rise in rates, and Dan pointed that out, the equity market wasn't all too pleased.
Yeah, I would just say this, looking at this 20-year chart, you look at that 150, level-ish in the 10-year, that's obviously going to be massive, massive technical resistance. I think it could probably float back there in optimism about fiscal stimulus, on vaccines, on, the economy doing better than people think sooner, that sort of thing. But if it goes through 1.5 on the upside, I think that's when people really start scrutinizing valuation a little bit. And just speak to 1 second on this. Is like this, the backdrop of this is that we're talking about this line, upper left, bottom right, but there's close to $20 trillion in sovereign debt globally that have a negative yield on them. What does that mean relative to our yields? And does it make the case that you might have moves here and there back towards that downtrend, the long-term downtrend, but we're never really meaningfully going to go much higher than that?
Yeah, I think there's obviously, that's a fair argument. The fact that you mentioned close to $20 trillion in negatively yielding global sovereign bonds, and I think if that's correct, it's about 27% or so of sovereign bonds globally. I mean, just think about that. It's a staggering number, and I might be off by a percent or two. That's about it. That's just, it doesn't make a lot of sense to me. But what I'm think you're talking about is relative value. So if that, in fact, that's the case, U.S. yields approaching 1% in the 10-year are very attractive. I think that equation gets blown up at a certain point, and I think the market is saying, wait a second, this is somewhat counterintuitive. And oh, by the way, I think that's one of the reasons Bitcoin has gone from 12,500 to close to 20,000. And the fact that gold still hangs in there, and the fact that the dollar continues to get torched on a daily basis. So all those things are part and parcel as to what's going on. So keep an eye on those negatively yielding bonds. That's been, again, in this stealth rally that nobody seems to want to talk about. But at a certain point, I think the market calls BS, and I think it calls it in the form of an equity sell-off, Dan, Nathan.
All right, let's lastly just kind of touch on the dollar that you mentioned is getting torched on a daily basis. Here's the 1-year chart. Draw the the downtrend any way you like, connect whatever dots you like. It's not a great chart on a 1-year basis, especially if you are bullish of US dollars here. You see that 92 level in the Dixie, this is the US dollar index, is going to be really kind of important near-term technical resistance. But then obviously that downtrend, depending upon how you drew it, we're kind of hugging it to the downside. Is this the sort of setup where you just keep pressing it? I don't love pressing things that look like this. It seems a bit aggressive. If I was trading the Dixie, and I had a bearish view, fundamentally, I might look to a breakout above that downtrend, kind of retest that 92 level. That's where I'd kind of lay out a short with a tight spot. What's your take, or a tight stop, excuse me. What's your take on the Dixie? And then we could also zoom in. We have a tighter chart here too.
So since we've been doing our IG slash and our Nadex macro setups, I've been pretty steadfast in my view that the dollar's going to go lower. So I'm going to stick with that. But I understand as a trader exactly what you're saying. Everybody seems to be lined up that way now, and that is somewhat concerning when there's a consensus trade on. But again, go back, I think it was a month or so ago, there was a great Citi note out speaking about how they saw a 20% potential downside for the US dollar in 2021. I agree with that. And if you really do take a look, and I know you watch these things, Dan, each rally has become more and more shallow in terms of the US dollar. So I think at a certain point, we break down. And oh, by the way, on December 14th, which was yesterday, I think that's when we made our recent low of about 90.40 or thereabouts. So, I think we're going to take out 90 on the downside, and I think we're going to test levels that we haven't seen basically in years. And if you really back out that move, that flight to quality that we saw in March in the form of the US dollar, the dollar has not, well, I'll say it, the dollar's been grim death for those that have been trying to play it from the long side. And I think, folks, whether you realize it or not, the dollar going lower, the US dollar going lower, is about as inflationary as you can get. So the fact that the Fed doesn't talk about inflation, they're just not acknowledging that the policies they've put in place have caused this dollar to weaken, and a weakening dollar by definition is inflationary. And that's me on my soapbox, Dan.
All right, let's wrap this thing up here. So just, my take is this. I think the S&P 500, I think there's risk to the 3,400 level. And then obviously 3,200 below that would be massive support, very near that 200-day moving average. I think the NASDAQ, the NDX in particular, and I think it probably comes around the time with whatever happens with Tesla into this S&P add on the other way. I think we're going to have a down 5% day in the NASDAQ very soon. I think the froth of some of these new issues, I think the fact that some of these stocks, and we talked about it, I said I like Amazon, I think Apple's hanging in there, this and whatever. I think you might get a snowball effect with all of these names, people thinking about re-rating these stocks like 1 or 2 turns lower as we head into the new year. But that might be the thing that you want to see, this SPX trading near 3,400. You see some froth come out of the NASDAQ, and that might set a better stage going into 2021. That's my take. As far as the Jan 5th runoff, we're not going to know the outcome of that. That might be the sort of market reaction we get in January. It might not be something that we start to discount before.
It's interesting. We didn't even bring up the fact that there was this cyber hack that basically was just spotted recently, and it took place in the spring. If you think about that, that to me is extraordinarily scary. Karen Finerman on Fast Money Monday night spoke to exactly that, and I agree with her. I don't like talking about black swans because by definition, it's very hard to identify one going in. You can only really talk about it going out, but that's about as scary as it gets to me. And the fact that, again, this has gone on for 6, 7, 8, 9 months before we learned about it is haunting to me, Dan. Haunting. And this was fun. The time goes by like this, Dan.
Like that.
And I just want to thank you for being here, but I also want to thank our presenting sponsor, Nadex. They're the premier U.S. exchange for binary options, call spreads, and what, Dan?
Knockouts, big guy.
Knockouts. You know what, Dan? You are a knockout. And I'll talk to you next week.
See you guys.